Recon Capital recently announced an options-based ETF in conjunction with the CBOE and NASDAQ. Joining me from the NASDAQ market site is Kevin Kelly, managing partner. Explain to us how an ETF is constructed before we get to the strategy.
Sure, an ETF is constructed where basically all the assets are held at a custodian bank, and then what happens is that there's market makers and there's authorized participants, and they actually buy the shares and help disperse them into the marketplace. So one of the advantages of an ETF is that it trades at its net asset value throughout the day. So investors can buy a product during the day and they get that liquidity, so they can go in and out during the day, and as opposed to a mutual fund where actually they're at the end of the day it's closed out at its net asset value.
So what's special about the Recon ETF?
Sure. So what's special about the Recon ETF is that we actually own all 100 constituents of the NASDAQ 100, and we actually write and overlay the index call option against it. So it's actually, there's two transactions in one. So clients actually don't need to buy all the constituents of the NASDAQ and then sell calls against it. That's actually in this one vehicle.
So what's the advantage here? Why not just go and buy the Qs?
Sure. The advantage here is that you actually get an options-based strategy that is different than the Qs. So the Qs, you have exposure to the NASDAQ 100. What part of this product is that you generate options income on the Qs. So you're still holding NASDAQ products, right? So you're holding Apple, Microsoft, Google, but you're also generating options income. So you're still collecting the dividends, but you're also collecting options income. So what that does is that lowers the volatility of the product.
So if it's covered call strategy, should the stocks appreciate, it should perform better than the Qs because you're also getting the income that's derived by the strategy.
Sure, in certain markets, right? So when the market went up 30% last year, we actually underperformed because you cap your upside. Because you're selling the call against it, the stocks can be called away against you. So what happens is that in big bull markets, the NASDAQ could be up 30%. The index that this was linked to was only up 15%. But in flat to neutral markets, you're collecting that premium every month so you can outperform the market or buffer any downside.
So if you're bullish on the market going into 2014, what sort of strategy would you employ with this?
Sure. Well, if you're bullish and you know certain sectors that you like, and we're actually bullish on the tech sector because those companies have great balance sheets, right? So they have a lot of cash. So what they're doing with their cash is they're doing buybacks, they're making acquisitions just like Google did with Next, as well as they're paying dividends. So if you look at a company like Intel, they've actually increased their dividend for the last 4 quarters and they have a 3.5% yield. So what this does is this actually helps you collect those premiums, and these are companies that don't grow at 20 to 25% a year because they're already more than $100 billion in market cap. So for them to grow 20% is a significant amount. So what we do is we collect premiums on that.
Okay, and finally, most importantly, what's the symbol and when do the shares start trading?
Sure, the symbol is QYLD because you're getting options yield on the Qs, and we started trading on December 12th.
Okay, thank you very much. For TheStreet, I'm Jill Malandrino.